Why is crude holding above $100, and how could that move your stocks, your rates, and your budget? Today's jump isn't just about oil, it's about risk, inflation, and what markets think happens next. Brent and WTI closed over $100 for a second day. Traders are looking past recent U.S. steps to cool fuel costs. They are focused on rising geopolitical risk tied to the conflict involving Iran. Comments from President Donald Trump that a quick resolution is unlikely kept a risk premium in place. That premium is now baked into futures and options, and it's steering day-to-day pricing. This is a classic case of geopolitics outweighing policy. Government measures can add barrels at the margin or signal intent. But when shipping routes, production safety, and escalation risk come into question, buyers pay up for security of supply. Even with physical flows still moving, markets price the chance that they may not. That keeps crude bid and volatility elevated. Risk management is amplifying the move. Energy producers, airlines, and commodity funds are adding hedges. When more players seek protection at the same time, option costs rise and liquidity thins around round numbers like $100. That makes intraday swings sharper even without new data on barrels shipped. The ripple effects are broad. Energy producers and oilfield services tend to benefit from sustained high prices. Fuel-intensive sectors feel pressure as input costs climb and pricing power is tested. Index performance can look steady while leadership rotates under the surface, with energy gains offsetting weakness in consumer and transport names. Inflation is the bridge from oil to rates. Higher fuel feeds headline CPI and can seep into core through freight and goods costs. If crude stays at triple digits, central banks may slow rate cuts or keep a cautious tone. That can lift bond yields, widen credit spreads, and weigh on equity multiples in rate-sensitive sectors. Earnings guidance is in the crosshairs. Companies exposed to fuel, shipping, and petrochemical feedstocks may trim margins or revise outlooks. Some will lean more on surcharges and efficiency. Others may delay capex or marketing. By contrast, strong cash flow at energy firms can support dividends, buybacks, and balance sheets. Here's the takeaway. Watch your sector exposure and your rate sensitivity. Consider whether your portfolio needs more energy resilience or explicit hedges. Track CPI prints, central bank language, and inventory data for confirmation. And remember, headline risk can overshoot. Plan, don't panic. Read the full article at finlitica.com.